New high briefly for NASDAQ today. Otherwise, not much conviction on the tape as we approach the close. So is there a catalyst to take stocks higher into year end? Let's ask Invesco's Brian Levitt and Wealth Enhancement's Ayako Yoshioka. Good to have you both with us. How would you answer that question, Brian?
Yeah, I think there's a catalyst. So the way I would categorize this is we're still in the middle of this market cycle. I don't have credit spreads blowing out. I don't have bankers tightening lending standards. So I feel good. What we're dealing with right now is economy slowing a bit. Usually when you're slowing, you tend to get some policy easing. We're debating that right now. So that's why it's feeling like a little bit, I wouldn't say challenged near all-time highs, but that's why people are grappling with this. Reality, when you're in a slowdown type of environment, it favors higher quality mega cap stocks, and that's the large composition of the broad index.
But that's the way it's been for a while. What tells you, though, that this is not a late cycle bull market? You know,
I would be
finished by a bigger slowdown and rate cuts and some of the hallmarks.
Yeah, I would be a lot more concerned if spreads were blowing out, if bankers were tightening lending standards, if this was an over-levered economy. None of that seems apparent. We all want broadening out. You and I have talked about it on this show. The way you get broadening out is policy easing and a reacceleration of the leading indicators, improvement in sentiment. And I think we'll get there. We'll get there without a recession, in my opinion. We're in a slowdown, even below trend type of an environment, largely because of the policy mix that we're grappling with right now, from both the trade perspective and from the Federal Reserve.
What helps you out, I guess, as well, Aya, but I'd love your view on it, the idea that any dips are going to be shallow and quickly bought by investors who still believe the hype.
We think so. It's tough. The economy is slowing down. We are seeing a moderation. But, as Brian mentioned and as Dan mentioned, structurally, the markets are just being led by very strong companies. And we've seen, second quarter earnings growth with 12% year over year earnings growth and 6% revenue growth. It's still a really strong market. And I think that that's going to continue to get bought because we are not seeing that over-leveraged, corporate credit issue really creeping into the equity market.
But Brian, like I asked Greenhouse a moment ago, is the market reliant on rate cuts? It sounds like at least you believe that part of it is.
Part of it is, yeah. For broadening out, you
but
would like to, a big part of it.
Like everything but the part of it.
Yeah. Well, there's certainly other parts of the market. I mean, one of the bigger surprises here in the financial sector doing well as the capital markets seem to be opening up a bit. Industrials doing well, playing off the artificial trade. But yeah, for those parts of the market, smaller capitalization, or those parts that are more reliant on short-term funding, yeah. So we're in a stage right now where the economy's slowing and the Fed's a little bit restrictive. When people talk about rate cuts, it almost sounds as if they're saying we need the Federal Reserve to come to a significant rescue here. What I'm suggesting is policy should be more accommodative in an environment when the economy's slowing. You look at what the two-year Treasury rate's telling us, the Fed funds rate should probably be 50 to 75 basis points lower.
I always think about the Gunlock rule of thought, the two-year guides the Fed.
Right. And right now, the Fed, of course, is waiting for greater clarity. The challenge you have is the longer you wait for greater clarity, more issues can emerge in the economy.
Well, that's the Bowman-Waller perspective.
Yeah, but I don't look. It's not an over-levered, over-excess economy, so we're not talking about a huge deterioration in activity. What we're talking about is this idea of a broadening of a market where it's not just a handful of names that continue to lead the market capitalization weighted index.
Aya, how about that? Is this a market that's going to be more reliant on rate cuts moving forward? We've gotten everything we can out of what we have to work with. Now we need a little bit of help.
Scott, I don't think the market has been that reliant on rate cuts, even last year, and I don't think it will be as reliant on rate cuts going forward. I know that certain parts of the market are a little bit more sensitive to rate cuts, small caps, as was mentioned before. But, in general, the U.S. market, S&P 500, is not as reliant on those rate cuts because a lot of the CapEx that we're seeing is coming out of free cash flow, and that growth is going to continue.